So good morning. So today we would be looking at financial instruments. Last week we looked at IS 36 on impairment of non-current asset. And the first thing I told you is that this IS 36 looked at non-current assets on how do we impair them. And when we talk about non-current assets, we have looked at IS 16 on PPE is a non-current asset. We have looked at IS 38 on intangible assets is a non-current asset. So majorly we have looked at those two regarding non-current assets. Today we'll be looking at another non-current asset, which is financial instruments, though not totally non-current. But what we looked at in IS 36 is that when you recognize and measure PPE or intangible assets in a statement of financial position, you must ensure that its carrying amount or the book value is never higher than what you can recover from it. It should not be higher than it. So what IS 36 is trying to do or try to do is that it wants whatever you put in your books to be realistic. It wants it to make sense, to put it that way. So that's why they said that if your recoverable amount, if it happens to be lower than your book value or your carrying amount, then you have to write down that carrying amount to its what? Recoverable amount. You see, when such situations happen, we say that the asset has been impaired. So we looked at impairment review. We looked at the actual process of determining recoverable amounts. We said that that process itself is impairment test. We looked at all of that. So majorly, we then deep dive into what recoverable amount is. We said recoverable amount is the amount that you recover either from selling an asset or from continuing to use an asset. Even at the end of its usage, the money you will make from even selling it eventually is also part of its value in use. So we said that the money you make from selling an asset, we call that net realizable value, being the sales proceeds minus the cost to sell. Then the money you make from continuing to use an asset, we call that value in use. Because now we are looking at the money you will make. This has to do with future inflows. So to get that value in use, you will need to discount them to present value. So we said your recoverable amount is the maximum you can make in either of those two. So we looked at recoverable amount as the higher of the net realizable value and value in use. And you know already that your carrying amount is either cost minus accumulated depreciation minus accumulated impairment losses if you are using a cost model. Or it could be fair value or revalued amount minus subsequent accumulated depreciation minus accumulated impairment losses if you are using a revaluation model. That is your carrying amount. Then the difference between those two gives you your impairment loss. And we said to effect your impairment loss in your books, you simply debit the assets. You won't debit the assets, sorry. You simply credit the asset to bring it down to its recoverable amount. And what do you debit? POL with the value of the impairment losses. However, if the entity were to be using a revaluation model, that means there's a possibility that there could be a previous revaluation surplus on the same asset. If there's a previous revaluation surplus, you will not just debit POL with the impairment loss. You have to debit where? OCI. You need to net off that previous surplus. Is any excess that you now actually take to the debit of the POL. We then went further that in order to test for impairment, we need to determine our recoverable amount. But there are situations where some assets, you might not be able to determine the recoverable amount because individually, they don't generate cash flows. Therefore, we cannot generate their value in use individually. So for us to do that, we have to group them with similar assets that generate cash flows together. IS 36 call that process or that similar assets together that you group together, it calls it cash generating unit. So when you are able to group them together, then you would be able to get their recoverable amount. And when you compare that with their carrying amount, you determine an impairment loss. And that impairment loss you determine, you have to share it among those assets within the what? CGU. And we said in order to share, you will need to first allocate impairment loss to a damaged asset. When you allocate to a damaged asset, if there's still any impairment loss remaining, that will be given to goodwill. If there's still any impairment loss still remaining, then that will be shared to other assets on a proportionate basis. And when you are allocating impairment losses to assets within a CGU, you see, the aim is to ensure that you bring the carrying amount down to its what? Recoverable amount. It must never go below it. So if the question gives us the recoverable amount of any of those assets within that CGU, that means just ensure you target the impairment loss or whatever you're going to write it down to that amount. And we saw a question like that, which was your past question, where they gave us the net realizable value, or that they said they wanted to buy one of the operating license of the company. What we ensured we did that, we ensured that the new recoverable amount of that item was that net realizable value. And that you have to take note of. And basically, that was what we looked at last week. And I gave you some assignments, which nobody did. Keep that up. Okay, now today, we are going to be looking at financial instruments. And this one is going to take us 2 weeks. We'll start today. We'll set up a theoretical background today, which is extremely important. Today, we are going to explain the core principles. Next week, we'll just solve questions. Then we'll round up on financial instruments. Okay, so the first thing is this. We need to understand what financial instrument is first. And I like to explain it very well with the standard. So what standard are we going to be looking at to address financial instruments? We'll be looking at 2 standards. The first one we're going to look at is IS 32. And this talks about financial instruments presentation. Financial instrument presentation. And basically what we will look at here is this. This will help us with all the relevant definitions that we need. It will also help us with something we call compound financial instruments. It will also help with compound financial instruments. So these 2, we would address it in IS 32. Then, we will also look at IFRS 9. And this relates to financial instruments recognition and what? Financial instruments recognition and measurement. So this will help us with the actual how you recognize and how you determine the value at which you recognize these items in your books. So these are the 2 standards that will help us dissect financial instruments. So now let's start with the definitions. Because that's how we're going to understand what financial instrument is. So let's start with the definitions. And that is taken care of by which standard? IS 32. Okay. So let's define financial instruments in line with IS 32. So IS-32 said that a financial instrument is a contract that gives rise to financial asset of one entity, that gives rise to financial asset of one entity, and financial liability or equity instrument of another entity. Okay. For me, the major part of what we'll do today is understanding this definition. When we understand it, I mean, we are 50% halfway. So this definition said that financial instrument is a contract that gives rise to financial asset of one entity and financial liability or equity instruments of another entity. So the first thing here is that financial instrument is a what? Is a contract. And the other standard we learned, that was 2 weeks ago, that we finished 2 weeks ago, that was also a contract, was leases, right? So when we see a contract, it means that there will be at least two parties involved. There will be at least two parties involved. And when we say something is a contract, it means majorly that we have an understanding, the parties have an understanding that we must act in a certain manner. And if any of those parties refuses to act, there will be legal or economic consequences. That's what makes it a contract. So financial instrument is a contract. So what will be in this contract? He said that this contract will give rise to financial asset of one entity. And, meaning is extremely important. It has to occur. And financial liability or equity instrument of another entity. That means these two are mutually exclusive, that they should not happen together. It's either financial liability or equity instrument of another entity. So what this definition is saying is that there has to be a contract, and this contract there will be two entities. One must have financial assets, must have a financial asset, and the other would either have a financial liability or what? Equity instrument. You see, this arrangement must exist like this before we can describe a transaction or a contract as a financial instrument contract. If this arrangement is not this complete, then it is not a financial instrument contract. Okay, now, to deep dive into this, we need to understand, when will an entity have a financial asset? When will it have a financial liability or what? Equity instrument. So let's consult the standard again. So what did the standard say about financial asset? The standard said that a financial asset is cash. Financial asset is cash. So what this is saying is this: if you have cash, then it is a financial asset. It's a financial asset. So what is cash? I mean, what they are talking about here is not cash in a raw form, but cash and cash equivalent. Majorly the money you have in your bank, majorly your bank deposits, or maybe you have like a 30 days treasury bills, or anything that you can easily convert to cash. That is what these guys are actually talking about there. So when you have something like that, then in your books, you should classify that type of item as a what? Financial asset. So the second one is financial asset is equity instrument of another entity. Equity instrument of another entity. So this simply means that you bought shares of another entity. That is what this second one means. So if you buy shares in another entity, that investment you have made, the way you classify it in your books, is a what? Financial asset. So you can buy shares in Google, you can buy shares of MTN, you can buy shares of any publicly quoted entity. Even if it is not publicly quoted, if you buy shares in a startup, the way you classify that kind of investment in your books, you classify it as what? Financial assets. That is an equity instrument. So equity instrument of another entity is a financial asset. And basically what this means is that you bought shares of another entity. Financial asset can also be a contractual right to receive cash. I'll stop there. Though the definition is more than this, but this is just sufficient for you, for your exam, for ICANN exam generally. So financial asset is a contractual right to receive cash. So you see, why some people are called rich, why they are called wealthy, is because they have this. When you have a contractual right to receive cash, it's different from PPE. It's different from that you have a building somewhere. No, it could be, but a right to receive cash means that as soon as you have done whatever you have done, that gives you that right. That thing that gives you that right is the asset. But this kind of right, you don't have to do anything. Just go anywhere. You can be in the Bahamas. You can be anywhere in this world. Money must come in. If money does not come in, you simply have to make one or two calls. That guy has started misbehaving again. Oh, let's go and carry him. Oh, they will go and carry him, or the guy will have to find a way to pay your cash. This is a right to receive cash. You don't have to do anything. It simply gives you the cash, whether he likes it or not. What kind of investment can give you a right to receive cash? The easiest one and the most straightforward one is a debt investment. Is a what? Debt investment. So a lot of people, you can give a fund or a mutual fund or some insurance fund. You can keep maybe 100 million there. You can keep 200 million there. At the end of every month, they might be giving you maybe 2 million or whatever it is. They have to give you every month. If they don't give you, you can sue them. Or you can give loan to somebody, or you can give the venture to somebody. What is key is that you have lent somebody money. That's how I want you to see it at a basic level. You lent somebody what? Money. So, what we have said in summary in this class is this. Financial asset is either of these three. For your own assessment, anytime in your exam you talk about financial asset, it has to be any of these three. Either it is cash, and this is cash and cash equivalent, maybe money in the bank, bank deposit, a treasury bill, something you can easily convert to cash, or equity instrument of another entity, meaning you bought shares in a company, or a contractual right to receive what? Cash. You lend somebody money. It's those three. Samuel. Can credit sales be regarded as contractual right? Yes. Yes. When you sell to somebody on credit, it gives you a right to receive cash. Okay? So that asset you record in your books is a trade receivables. So that trade receivables is a financial asset. That's a good one. Because what you are expecting from that person is nothing but what? But cash. Except if it's an exchange agreement that he won't give you cash, he will give you something else. Okay? So there are a lot of stories around that. But that is beyond the scope of our class. I won't go into that. Okay. So when you have any of these three, then you have a what? financial asset. Now let's look at financial liability. So financial liability is a contractual obligation to deliver cash. I'll stop here, even though the definition is beyond this, but this is just sufficient for us in your exam, even if they ask you that you should define a financial liability. So a financial liability is a contractual obligation to do what? To deliver cash. So what this simply means is that you have borrowed money. You have done what? You have borrowed money. So when you borrow money or when you buy goods on credit, meaning you're supposed to deliver cash to the supplier, then you have a financial liability. So if I want to go back to this definition, that means that if what this guy has invested in is a debt instrument or he lent somebody money, that means automatically what the other party would have is a what? Is a financial liability. Is a financial liability because this definition expects that when somebody have an asset, another party must either have a financial liability or what? Or equity instrument. So if it happens that what this other guy has invested in is that he lent somebody money, therefore he has a contractual right to receive cash, automatically the other party must have a what? Financial liability. Then it's complete. But if what this guy has invested in is equity instrument of another entity, the other party cannot have a financial liability. It cannot. Because when you buy shares of another company, me, in my books, I have an asset because I'm the investor. I bought shares. The other party does not have an obligation to deliver cash to me. It doesn't. When you buy shares in a company, they don't have to pay you dividend. It's only when the management believes that they have made sufficient profit and they don't want to plow it back, then they can declare dividend. It's always at the discretion of the management to declare dividend or the board of directors. They can decide otherwise. That's why a company like Amazon, for many decades, when I say many decades, I meant it, the guy did not declare dividend because they said they were investing for growth. And the shareholders did not complete, though they are reaping it now. But really, when what you have invested in is you bought shares in another company, then just know that the other party cannot have a financial liability. He cannot have. What the other party will have is something we call what? Equity instruments. What we popularly call share capital. That is what the other party will have. So let's look at equity instruments. Equity instrument is a contract that evidences the residual interest in the asset of an entity after deducting all its what? Liabilities. We have seen this definition before in the conceptual framework. So, equity instrument is a contract that evidences the residual interest in the asset of an entity after deducting all its liabilities. So majorly what equity means is share capital. So You have equity instruments if you are the one that issued out shares. If you are the one that asks people to come and buy shares in your company, you want investor. Then in your books, you have equity, what we call share capital. And equity also includes anything that increases your share capital, like reserves, retained earnings, revaluation surplus, share premium. Anything that increases your share capital are equity instruments. And this is just by definition, they are residual interest because they are the ones that we consider last. Okay, so the three arrangement is complete. The point is this. The starting point is always this guy who is the investor, because in this financial instrument arrangement, it will always exist. It will always exist. In fact, he's the one that makes it happen. If this guy does not act or does not reciprocate, there will not be any financial instrument contract. So by the time you put money in your bank, by the time you put money in your what? In your bank, that is, you have cash in your book. That cash or that bank deposit you have is a financial asset to you. Do you know what the bank has? They have a financial liability because they have obligation to deliver your what? Your cash at any time you knock. If what you have invested in is that you bought shares in another company, automatically that means the other party will have what? Equity instruments or share capital. If what you have invested in is a debt instrument, which gives you a contractual right to receive cash, automatically the other party will have what? Financial liability. And that's how you should look at it. It's not really more than that. Okay? So the way it works is this. The person that wants to borrow money, who is the guy that will eventually have a liability, is the one that will come and knock on your door. It's not you that have money that will be looking for somebody you want to give money to. It's the people that need money that will come and knock. So in your exams, the way you will see them put it, they could tell you that Wasi PLC issued a loan note, or Wasi PLC issued a debenture, or Wasi PLC issued a commercial paper. Issued. That's how they will put it. Issued. Because the way it works is there will be a contract. That's why it's a contract. So the guy there will be a lot of things, agreements. So that's why they say he issued a contract. So if this guy should eventually key and gives him money, then this one will have a financial asset, while him will have a what? Financial liability. So the way they will put this guy, they will say this guy, let's say he's Lecom PLC, they will say he invested in, or they will say he purchased a loan note, or he purchased whatever instrument the guy has, whatever. In this other round, they will say Wasi PLC issued an ordinary share capital, or Wasi PLC issued a preference share capital. That's how they put it. Why this guy will have purchased it, okay, will have invested in that share capital. And that is it about the definition of financial instrument. Okay, so this is the starting point. This is the starting point. So last diet, for 3 marks, they ask you to define financial assets and also financial liability. That was the question 5 under section C of last diet. 3 marks. Explain or define financial asset and financial liability. If you are able to remember this one, and give them financial liability is a contractual obligation to deliver cash. That will have earned you at least maybe 1.5 marks. Why this one gives you another 1.5 marks? Then you have easily picked clean 3 marks from that kind of question, which are the questions I like my students to answer in the exam. So now, for me to know that you understand what I've just mentioned, let's open our pack, this public sector. Let's open our pack to this is old pack. Let's open our pack to page 81. Page 81, question 1.3. Page 81, question 1.3. So, with this explanation I've given you, I would expect to hear from you guys. I'll just call any of you to answer any of the questions while Sam will read. So, are you all there? So let's start from the requirement of this question. What does this question ask us to do? So Sam, start with the requirement.
Okay, we want to determine whether the items above are financial assets or financial liability, and also states whether a financial instrument exists as at 31st December 2021.
Okay. So when I call on you, what this question is requesting is that you tell us that from whatever transaction it is, tell us whether the company has either a financial asset or a financial liability or equity. You just tell us, he has a financial asset, or you tell us he has a financial liability. You shall tell us. When you tell us that, then you then tell me that is there a financial instrument contract? There will be a financial instrument contract if there's another party that has either liability or what? Or equity. Then that arrangement is complete. Okay? So you tell us whether there is a financial instrument contract or not, and you tell me why. Why you think there's a financial instrument contract. Okay? So take. Start from you. So read the A part.
The A part.
Yeah.
Okay. So the following relates to Network PLC for the year ended 31st December 2021. A. Network owns cash of 5,000 naira. Network owns cash of 5,000 naira.
Okay. So
So
network.
yeah, network owns cash.
We have cash of 5,000.
Okay. Okay. This is not So there's no financial instrument here. Like there's no contract. I don't
Okay.
think there's a
Let's
contract.
start. Let's take it step by step. Let's take it step. You need to calm down.
Okay.
So network.
Yep.
What does it have? Does it have a financial asset or a financial liability?
Okay. Network has a financial asset.
Network has a financial asset.
Asset, yes.
Why?
Okay, because he has a sum of 5,000 naira cash.
Financial asset is cash.
Yeah,
Abi?
it's cash. Yes.
Okay. That's one. Two. Is there a financial instrument contract here?
Okay. From the look of it, there is no financial instrument contract here
Why?
because there is no another party with a liability or with a contract.
Okay, that's absolutely correct. That's absolutely correct. So yes, even though Network has a financial asset, which is cash of 5,000, but there is no other party that has either a liability or equity. So if there is a financial asset, quite all right, but there is no financial instrument contract in this arrangement. So for that reason, we cannot progress. Okay. All right. Timileyin, am I correct? Okay. So do question two.
So, Network owns a demand deposit of 1 million with First Bank.
Okay.
So, this is a financial asset, and there's a financial instrument because First Bank here has a contractual right to deliver cash when needed.
Yeah. You mean contractual obligation to deliver cash. That's absolutely correct. So Network has a demand deposit of how much? 1 million naira. So Network has a financial asset because demand deposit is cash. Okay. Not only that, it's even a contractual right to receive cash when you have a demand deposit. And automatically the bank, which is First Bank in this case, has an obligation to do what? To deliver cash. Okay. Yeah. Do the third one.
Net worth statement of financial position includes 2.5 million shares of Google Incorporated. This is a financial asset. Net worth has the equity investment in another equity or entity rather.
Okay. But is there a financial instrument contract?
There would be
Right?
there's an instrument between net worth and Google.
Okay. So you said Network has a financial asset. That's
Yes.
correct. What does the other party have? Which is Google.
They have the equity instrument.
That's correct. That's correct. So network bought shares of Google. Therefore, network has a financial asset. Which is that third one? Which is the second one? He has invested in the equity instrument of another entity. And immediately you invest in equity instrument of another entity. That means that other entity will have what? Equity, which is share capital. We got you? Do the next one.
Net worth statement of financial position includes inventory of 56,000 naira. Okay. There is no financial assets.
Okay, there's no financial asset anywhere. Okay. So is there a financial instrument contract? Even when there's no financial
No.
asset, that means they can't be. Yeah. Is she correct? Is she correct? Mr. Omar says no. Mr. Omar says no. Why is she not correct?
The reason why I said it's not correct, inventory is a cash equivalent. That's the way I look at it. And there is no contract since there is no other entity to the contract.
Okay, so the reason why he thinks you are not correct is that inventory is a cash equivalent. So inventory is not a cash equivalent. If that's the reason why he said she's not correct. Cash equivalent is something that you already have it, it's your own cash. You just need to ask your cash. That when you say easily convertible to cash, is that you make request, then they will give you cash. Inventory is yes. Inventory, if you don't send anybody to buy it, you cannot get cash. You have to sell, you have to hustle. But cash equivalent, there's no need for hustling. All you just need to do is just to write letter. Now, please give me my money. Hold on. So that one is what we call cash equivalent. So if that's your reason why you said she's not right, no. So is there any other person that thinks she's not right? Okay. Dominic, right? Dominic, are you listening with this thing you have in your ear? I'll seize it now. I'll seize it and I'm going to be using it. So you think she's not correct, right?
I think she's correct, but this is my reason. I feel like inventory is a non-monetary item. Yeah, it doesn't have like a fixed cash rate on it. It's subject to value. Yes, so
So yeah. So Dominic is actually supporting your point that you're correct. So I also agree with you. You're correct, right? So inventory here is not a financial asset. Inventory is not cash. Inventory is not shares. You didn't buy shares in a company. Inventory is not debt. So if it's not any of those three, automatically it's not a financial asset. So when there is no financial asset, that means there's no possibility for a financial instrument contract. Okay, I won't call you yet, but I'll definitely call you. John, the next one, give it to John.
Okay. That is A. Net worth sold goods amounting to 55,000 to Lai Limited on credit.
Okay, network sold goods. Can you tell us?
Yeah, it is a financial asset because net worth is actually respecting the specific amount 55,000 now from Lai Limited.
That's true receivables.
Yes, true.
Okay, is there a financial instrument contract?
Yes, there is. Because now Lai Limited, so they are the one that's going to make payment to net worth. So because the goods has been given to them already. So
That's the trade payables, right?
yes.
Okay, that's also absolutely correct. So that's like a credit sales. When you make credit sales, net worth has a trade receivables. That trade receivables is a financial asset, while the other party, which is Lai Limited, has a trade payable, and that is a financial liability. Okay, Unisa, do the next one.
Which one? Okay. On December 31st, on December 2021, Network received an advance payment of 250,000 naira from one of its customer, Mori Limited, to deliver goods in January 2022. It's not a financial instrument, and because the reason why it's not a financial instrument is because this is a deferred liability and not a, what is it called, financial liability.
Yeah, that's absolutely correct. But do you agree with him? What he's saying here is this: that network doesn't have a financial liability. What did they say happened? He received an advance payment of 25,000 from one of his customer, Muri, to deliver goods. So he said that this in 2022 that this is not a lie. Network doesn't have a financial liability, while the other party doesn't have a financial asset. Do you agree with that? Okay, let me give to Festus.
Um, for me, I think he receiving cash. There's a financial asset, but this contract should be classified under IFRS 15, sales of goods.
Okay, so there's a contract. So you're saying that there's no financial liability, no financial asset. Is that what you're saying?
There's no financial liability. It should be classified. It's a contract, but since it's a contract that it should deliver a service in a different service later, so it should be classified under IFRS 15, sales of goods.
So it's not here. Okay, not bad. Okay, to save our time, yeah, they are correct. They are actually correct. But I've not really had good reasons why they are correct. Yeah. So why is network not having a financial liability? You said yeah, it should be classified under sales of goods. What about that credit sales? Why is that one? Is that not what? Is that not also sales of goods? The one before it, that credit sales. So that's not the reason why it should not be a financial liability. Yeah, I agree. Okay. Fantastic. 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 That is it. Because one network is actually stated clear, there very clearly that one network to deliver is goods. That means it's not a financial liability. For it to be a financial liability, what you must deliver is what? Is cash. And yeah, Unisa is right. He said that in your books, instead of putting it as a financial liability, you put it as a deferred income. Okay? As a what? Deferred income. It's a liability also, but not a financial liability. Because in financial liability, what you have to deliver is what? Cash and not goods. Right? The other party, what is expecting to receive is goods and not cash. Okay, so the other guy too, he has an asset because he's expecting to receive goods. Anytime you're expecting to receive goods or services, so you call that prepayment in your books because you have paid in advance. That's prepayment. Prepayment is not a financial asset, right? Okay. Gloria, then Udo. Gloria, do the next one.
Which one? Net worth statement of financial includes a current tax liability of 5,000 as well as deferred tax liability of 6,500.
So
There is
let's
no
take it one by one. There are two items here. There is current tax, there is deferred tax. So you tell me the current tax, you tell me the deferred tax. So let's start with the current tax. So when you have current tax in your book, is that a financial asset, financial liability or equity or none?
I will start by saying that it's not a financial instrument because two parties are not involved here. And the current tax is
is a financial asset.
Okay, you have made your attempt. You want to help her?
No.
No. Okay. Do you want to say
No
something?
one is. No.
You want to say something? There is no contract. So you are saying that. So what does network has for that current tax? Okay, he's right actually. He is right. Yeah, he's right. He said that when you have current tax in your book, you know what current tax is now. So he said yes, network has an obligation to pay cash to deliver cash, but it's not contractual. That is not contractual. The government has a right to receive cash, but it's not contractual. It's not like you have a contract with the government. It's just statutory. It's constitutional. It's your civil obligation to pay tax. That doesn't mean it's contractual, right? So it is not a financial liability. Current tax is not a financial liability because there is no contract between the entity and the government. And financial instrument must be a what? A contract. So it's absolutely correct. So that's for the current tax. Now, what about for the deferred tax? What about for the deferred tax? Who can attempt that? Who can attempt the deferred tax part? Any volunteers? Any volunteer? Deferred tax. So when you have deferred tax, I mean, the question is that do you have a financial liability? No. Why? Okay. Do you know what deferred tax is? You know, deferred tax is not a tax you pay in the future, right? It's not a tax you actually pay. It's not something you would ever pay. Deferred tax is just trying to accrue for tax. Trying to accrue for what? For tax. Deferred tax is just an arrangement where you have an amount in your books, but the taxman says that this amount, I'm not going to allow it this year, but next year I will allow it. So there is a temporary difference between when you have this item in your books and when the taxman will allow it. That difference is different. So what accountant came up with is this. Since the taxman is saying they won't consider it now, but they will consider it in the future, let's accrue for the tax. Let's do what? Accrue for the what? For the tax. So by the time that different tax is just an accounting measure, in the future, by the time they are considering it, it nets off. It will net off our books. It's not something we ever pay. Even though when we are explaining it to you, we will say it's a tax that is payable. No, it's not payable in the future. It's just based on understanding that okay, let's accrue for this tax. So in the future, by the time you reverse it, you don't reverse it with cash. You reverse it with the actual occurrence of that tax, which will actually cancel out. I mean, I don't know whether you understand that or not, but you see, for deferred tax, it's not something you actually pay. So for deferred tax, clearly, there is no obligation to deliver cash. Deferred tax is just an accounting measure that is used to match tax and account so that our books will follow accrual convention. Okay, that's for the deferred tax. So let's do the last one. This is the last one, right?
Yes.
Okay. Oh, that's the one the easiest. So yeah, quickly do it.
Networks purchased a Bitcoin of 5,500,000. So that's what is it? Equity instruments.
Okay, Udo.
I think it's an equity instrument.
So what does net worth has?
Financial assets.
Okay, so when you have Bitcoin in your books, that's a financial asset. Okay, do you agree with that? Okay, so it's a financial asset because no Bitcoin. So it Bitcoin shares. Is Bitcoin shares? Bitcoin is not shares now. So why are you saying equity instrument? It's not like take that off your mind. Bitcoin is not shares. Equity instrument is nothing but shares. Nothing but shares. Okay? So you are saying Sam said is a cash equivalent, right? Yeah, it's an investment. Yes, it is an investment, a very risky one for that matter. Yeah. So later. Okay. So that means we all agree that this is a financial asset. Right. So that means we all agree that you are all wrong. Yeah, that you are all wrong. It is not a financial asset. Bitcoin is not a cash equivalent. Yeah. IS7 says that cash and cash equivalent is a legal tender or a medium of exchange that is generally acceptable. That is what? Generally acceptable. That's one. So Bitcoin is not generally acceptable. Two is that a cash equivalent must have an insignificant risk of changes in value. You all know that Bitcoin is highly volatile. Something that can lose in one day almost $2,000 or even more in a single day. That cannot be described. That does not meet cash and cash equivalents according to IS7. Even though with the Naira, the way the Naira is doing right now, I'm starting to consider is this one because it does not seem to meet that definition again. But I don't understand though. In fact, me that I'm an advocate of Nigeria. That I'm, that I'm always preaching for Nigeria. I'm getting scared right now. But it's okay. We'll get there. Okay, so Bitcoin is not a financial asset. It's not cash. In Nigeria? No. We're talking about in a country. Yes, now. They have absolutely lost confidence in the Naira. But we should not do that. You should never do that. You should never do that. Nigeria remains the only country we have. Whether you protect it or not remains in your hand. All of you can travel abroad. Yeah, whatever you do to the country, we will see it. You should never do that. But the problem is we ourselves. We don't just have this. We need to. I don't know, but no problem. We'll get there. So now, Bitcoin is not cash. It's not cash. Bitcoin is not shares, and Bitcoin doesn't give you a right to receive cash. You have to sell it. You have to make effort. You don't just sit down and scribe. You need to find a buyer for your Bitcoin, right? It's just like when you buy shares, you need to find a buyer for your shares before you can sell it. So Bitcoin is not a financial asset. Then the question then comes to what type of asset is Bitcoin? Because we have companies that actually buy Bitcoin. Yeah. As a form of investment, buy it. Some people have made so much money from that arrangement, a lot of money. Yeah, a lot of money. Because there was a time it was very low, but now it's huge. So, yeah. Okay.
My question is, other countries' currency in a different domicile, like in a different country, can it be, um, can we say that it's a financial asset?
Oh, okay. If you have, let's say you have dollars now. Yeah, it's a
Yeah,
financial asset.
okay, in a
Yeah.
different,
Yeah. If you have dollars,
because,
just that according to IS21, every country has a functional currency, okay, as well as a reporting currency. So if you have dollars in your domiciliary account, when you're preparing your books, you need to translate it to naira. Do you
Okay.
get? So eventually in your books, it doesn't show there in dollar, right? Though you describe it as dollar balance, but you have translated it to naira at the rate. The standard
At the
says that
prevailing rate.
it's a monetary asset, so you convert it at the closing rate.
Okay.
Okay, convert it at the closing rate, meaning the rate existing at the year end or at the month end, or whenever you're translating it. Okay, so tell me, how do we classify Bitcoin? What type of asset is it? Let me restrict your scope. Is Bitcoin PPE? Is Bitcoin PPE? Okay, why? Because it's not held for production or supply of goods or services. Abi? So it is not PPE. Secondly, is that is Bitcoin what do they call it? Intangible assets. Oh yes, Bitcoin is an intangible asset because Bitcoin, if you look at intangible asset, it says it's an identifiable non-monetary asset without physical substance, right? So Bitcoin is identifiable because it is separable. You can easily sell it. You can sell it, and it is a non-monetary asset because you don't know how much you will get back. It's actually the amount you get back, it varies, it changes. So it's non-monetary, and also it's without physical substance. It's a digital asset. So Bitcoin checks all that definition or that element. So it's an intangible asset. But it's not only an intangible asset, it can also be an inventory. Yeah? Inventory is any item that is held for sale. So if you have your inventory, if you have your Bitcoin, majorly for you to sell it to other people, those other platforms that sell inventory, those platforms that sell inventory, they actually will categorize their inventory as what? Their Bitcoin as an inventory. Okay? So that is how this one will operate. So this one, there is no financial asset and there is no financial instrument contract. Right? So if I may ask you, somebody actually asked me in one other class, MTN now, those airtime they are selling to us, the airtime they are selling to us, how will you categorize it? What type of asset is it to MTN? Airtime, those things that you buy from them. Inventory for MTN. Okay? Me. Really, is MTN a publicly quoted company? Yes. That means you can easily check their financials and see. I don't think it's an inventory, right? I don't think it's an inventory because the airtime is not as if it is there that they now take it and now sell it. It's not like they have, it's not quantified. It's probably going to be like they won't have airtime in their books. What they will have is the technology that powers the production of the airtime. And that will be more like an intangible asset, right? That would be an intangible asset. Something that, asset is something that produces, right? So that airtime itself will not be an inventory. It's going to be an intangible asset. Okay. So that is that. You did perfectly well here. That means you understand the background. Okay. So let's move forward. 9:30. Okay.
If network prefers shares instead of Bitcoin, this will not.
Yeah, we have done that in, I think, D or E, where they bought shares in Google. That's equity instrument of another entity. So network will have a financial asset, while the other entity will have an equity instrument. Yeah. Okay. So we have 1 hour to go. And this 1 hour is going to be intense. So you need to pay maximum attention now. Right. So we have looked at the definition. So this checks out. we can't look at this one yet because we will need some knowledge here. So I would postpone this till next week, probably. Yeah, hopefully. Then let us do this. IFRS 9 on financial instruments, recognition, and measurement. So the first thing here is recognition of financial instruments. Recognition of financial instruments. And when we say recognition, we are talking about recording an item into our books. So what is the recognition criteria for a financial instrument, whether a financial asset, liability, or equity? At what point do you enter it in your books? The standard said financial instrument is recognized. Financial instrument is recognized when an entity becomes a party to the contract. Financial instrument is recognized when an entity becomes a party to the contract. Of course, they can ask you this in the exam. So you just simply need to tell them this, that you recognize financial instruments when an entity becomes a party to the contract. Of course, that should make sense to us because financial instrument is basically a contract. So as soon as you become a party to that contract, that is when you can recognize the financial instrument in your books. And you become a party either when the contract commences or when you make a commitment, right? When you make a commitment, meaning you have invested, whether in equity or in debt, then automatically you recognize it in your books. So that is recognition of financial instrument. Then let's look at derecognition. Derecognition. So let's start with financial assets. So derecognition of financial assets. Derecognition of financial assets. So when do you derecognize financial assets from your book? So even if you don't remember all of these points I'm going to tell you today, all you just need to do is remember the definition of what a financial asset is. And just think about at what point can you actually remove any of these items from your books? At what point can you remove your cash from your books when you have spent your money, right? At what point do you remove your shares? You bought shares in a company. When do you remove from your books? When you sell the shares. At what point can you remove your debt investment from your books? Exactly. When they are finished paying you. So this point, this technical point I'm going to state here, if you cannot remember that and you tell the examiner that you do recognize a financial asset, either when you have spent your cash, or you have sold your equity investment, or you have finished receiving, or they have settled you, then you're correct. So look at the way this guy put it. He said you do recognize a financial asset when when the contractual rights, to receive cash expires. When contractual right to receive cash expires. So when it has expired there, then you need to remove it from your books. That means those guys have settled you. That's what it means. And the second one, the standard says that when you have transferred substantial risk and reward, when you have done what? Transferred. When there is a transfer of substantial risk and what? and reward. And what this simply means is that you have sold the financial asset. You have sold it. So what this means is that there is an unconditional sale. Unconditional sale of the financial asset. You have sold your financial asset. Then you need to derecognize it from your books. So these are the derecognition criteria according to IFRS 9. Either when your contractual right to receive cash has expired, or you have transferred, when there is a transfer of substantial risk and reward, which means that there is an unconditional sale, because there are more stories to this, majorly. This is just what you need in your exam, more stories to this. So, because there are some sales that can be conditional, and there are requirements that you need to meet before we can say you should derecognize. But the straightforward one for you guys is that you have sold it and it is unconditional. Meaning you will not say you want to buy it back later in the future or what have you. Okay, so that's for financial asset. Now, financial liability, derecognition of financial liability. So at what point do you derecognize your financial liability? So you would recognize it literally when you have settled. Abi? So the way the standard puts it is that is when the obligation has been extinguished. Extinguished. Now say that is cancelled, settled, or expires. Okay, this is what they mean by extinguished. Either when it has been cancelled, you can cancel it and say, don't worry, don't pay again. Or you have settled, or it has expired. Expired means that maybe the period or the amount you're supposed to pay is over. Okay, so that's the recognition of financial liability. Finally, is equity. Mr. Omar. Somebody can forgive you your liability now and say don't pay again. It's a possibility. It's a possibility. Okay, finally is equity. so, so if somebody die, it's very unfortunate that the family will have to pay. Somebody must pay. And because chairman, we are not a partnership. I lent you money. You have to pay back, whether in your presence or in your absence. Even going to the secular world, I'm a Muslim. As a Muslim, if your relative die, you need to find out whether he's owing anybody money. You have to. If he's owing anybody money, make sure you settle, because when he gets there, he will pay in another way, and that one is not good. So at the same time, if somebody dies and there's anybody that owes the person money, you have to go and find a way to. So when we were young, when we were still like 12, 13, we were very young, myself and our friends were contributing money. The 5 naira they gave us, the 1 naira. So we were doing our job. Unfortunately, the guy died. Yeah, he died. And me, when I was young, I was an alpha. I mean, I went to Arabic school. I could even speak Arabic fluently then. So I knew the implication. I just went to tell my mommy, his money is with me, and all of that. Because all through the time the money was with me, I could not sleep because I know the implication. I cannot be in obligation to that person. So my mom went to meet the mom and they gave the money. That was when my mind. So to answer your question, here too, he has to pay back, whether he die or whoever, he has to. Okay, so equity. How do you remove equity from your books? When I say equity, you know what I mean is share capital. So how do you remove share capital from your books? What do you think? At what point can you remove your share capital? That you can't remove it. Why? And when you sell your share capital, when you share you that you have share capital, you know when you say share capital, that's the money you use to start your business. Can you sell that? That means you are looking at it from the guy that bought shares. That's the one that can buy sell. You that you are the one that issued the share that your company you cannot sell. That means you are saying you sell your company. That means you sell the entire company and you just leave it over. So first off.